Hi, everyone. I'm Faisal Butt. I'm the CEO of Pi Labs. Thank you all for joining us today. We have almost 1,000 people tuned in from around the world, including staff and senior management from some of the largest real estate companies globally, including our own LPs, Great Portland Estates and Patrizia, as well as other major global real estate firms such as Blackstone and Starwood. For those of you who don't know Pi Labs, we're a London-based VC investing in prop tech across Europe. We've made 53 investments over the past 5 years across 3 funds. It's been an exciting journey as we've grown from a standing start in 2015 to a portfolio company gross value of over 400 million. Our vision is to act as a gateway between the traditional bricks and mortar real estate sector and the emerging and rapidly changing prop tech world. And we've worked hard over the years to create a global ecosystem of prop tech startups, mentors, real estate companies, developers, real estate investment managers, and other VCs, all of whom have helped us elevate our portfolio companies to the global stage. We're committed to investing in the most promising and transformative prop tech startups in Europe and help to scale them to enter international markets. Research is an integral part of what we do. We're a thematic and research-led investor. Earlier this year, we published a research white paper on sustainability in the built environment and have made a number of investments in this space, and ESG in prop tech remains central to our investment thesis. This summer, we published another white paper on the future of work and have actively been investing in technologies for the future of the workplace, not only this year, but over the last couple of years. And as we all know, this is especially pertinent today as the pandemic disrupts our lives globally. Our research and our investments go hand in hand. We invest in the topics that we choose to research and vice versa. Today, I'm very pleased that we're launching our research on the future of real estate investment management in partnership with the University of Oxford Saïd Business School. In our research paper, we've broken down this industry into its component parts, such as capital raising, investor onboarding, asset management, deal sourcing, and due diligence. And we've tried to identify the key challenges the sector faces today, as well as the emerging and potentially disruptive technologies that will shape the sector in the years to come. On that note, I'd like to hand over to Professor Andrew Baum, who alongside my colleague, Andy Saull, will present our research findings. Thank you everyone for joining us today.
Thank you, Faisal, and thanks everybody for joining this webcast. It may be that the right thing to do is to ignore technology and hope everything will go away, but it seems unlikely that that's the situation we're currently in. My name's Andrew Baum. I'm Professor of Practice at the University of Oxford Saïd Business School, where I lead the Future of Real Estate Initiative, which is where I was a colleague of Andy Saull until very recently. I'm also chairman of New Core Capital Management, which recently achieved B Corporation status, and B Corporation status balances purpose with profit. It may be a sign of the pressure on fund managers to come that we need to balance purpose and profit a little bit more. So I'm looking forward to presenting. Andy, over to you to kick us off with the presentation.
Thank you, Andrew Baum, and hello everybody. I'm Andy Saull. I'm the research associate here at Pi Labs, and alongside Andrew, I'm the co-author of Technology and the Future of Real Estate Investment Management. Just a small bit of housekeeping. There is a Q&A function at the bottom. So if you'd like to ask any questions about the presentation, please pop some questions in the chat. And we're going to have an hour's panel discussion after to go through some industry reactions to the report. And again, you can ask any questions that you'd like to panelists through that Q&A function, and myself and Andrew will be checking that regularly. So without further ado, I'd like to introduce the paper, Technology and the Future of Real Estate Investment Management. Our motivations for writing this paper is we felt that there was a lot of reports saying why real estate management should change. But there was very few reports saying how the investment management industry was going to do so. So what we've done, as Faisal pointed out earlier, is we've broken the investment management process down into 2 key functions. The first is distribution, and this is the raising and retaining of capital, and it includes those processes you see below. The second function that we look at in the report is manufacturing, And this is to do with deploying and managing capital. And again, you can see those processes that we deem to be manufacturing on the screen. The report looks at each of these sections in turn and identifies the inefficiencies caused by current processes before highlighting real industry case studies and where startups can be applied in order to overcome some of these inefficiencies. And for the next 20 minutes of this presentation, we'd really like to share with you why we believe that if you're not already experimenting with the use of alternative big data, proprietary machine learning models, and emerging digital platforms, you are running the risk of becoming a clear casualty of digital transformation. So with that, I'd like to hand over to Andrew Baum, who's going to discuss the current challenges facing the real estate investment management industry.
Thanks, Andy. I mean, it seems to me, from my perspective, over the last 10 years, it seems to me that fund managers are getting into a challenging situation. And I think this started with the global financial crisis in 2007, when the damage to returns, particularly in value add funds through over leverage, created a bit of doubt in the minds of investors. A lot of investors took back control by forming investor consortiums. In the UK, we've had the local government pension schemes getting together, taking back a little bit of their control. We've had a decline in the natural supply of defined benefit pension schemes being replaced by defined contribution, which finds real estate less easy to deal with. So all of those problems are then coupled with fund formats, where the closed-end fund format is challenging for investment managers. Starting a business, then closing it down doesn't make a lot of sense. And yet at the same time, the open-ended structure is challenged because we've seen gating of funds, down valuation of funds happening in 2007, 2012, and again recently through Brexit and last year through the COVID crisis. So we've had a whole set of challenges to the fund structure as well as the natural business of fund management. And then on top of that, we have the more recent challenges that are epitomized by Greta Thunberg, challenging us all to create a better world, and fund managers need to take responsibility for that. We're going through a technological revolution, which some call the fourth industrial revolution, which kicked off in some weight in around 2008, and really got going in 2015, by which time we've measured 7,000 prop tech startups, and now we're seeing more and more money come into this sector, so that there are now significant sums of money, something like $50 billion invested in prop tech, a lot of which is very relevant to investment managers. If that weren't enough, we've now got investment managers struggling to justify their fees, given that returns are now going to be lower than ever before in a low interest rate environment. So we're now looking at core fund returns of often 4 or 5%, 1% of asset values against 4 or 5% returns is a big slice. And on top of that, we are worried about the retail sector has gone through a real significant decline thanks to online retailing. And now we're worried about the other core sector, which is offices. And so the sort of core property sectors are now difficult for us to think through. And we're having to think about alternative investment sectors to invest in. We've had this decline in the natural supply of investment and the way in which investor groups operate, often through clubs. And that's getting slightly harder to raise capital. And we still have this ridiculous world where fund managers get on a plane and travel around the world, meeting people, trying to raise capital, when pretty much every other industry is using some sort of online platform or the app store to market its products. Then we've got increased regulation. So KYC, money laundering checks, know your customer, all of that has cranked up since 2008. And as I've said before, the lower core returns is a problem for a lot of core fund managers. So from my perspective, both as an academic, but also as chairman of a fund management business, I see that there's a tremendous amount of challenge around at the moment for fund managers.
And compounding these issues, the real estate investment management industry is notoriously analog in its approach to everyday processes. Deals, as Andrew pointed out, are sourced face-to-face through personal networks, relying on rumour and market hearsay. We hand-sign documents to send in the post, only to then be scanned, uploaded, and stored in filing cabinets. It's reported that 60% of firms are still using non-specific software, so spreadsheets, think Excel, for reporting, 51% for valuation and cash flow analysis, and 45% for budgeting and forecasting. 45% of commercial real estate teams spend over 15% of their time managing data, while for 12%, they're spending over 25% of the time managing data. That's 12% of real estate firms are spending 3 or more months of the year managing their data. Fortunately, the report identifies some management models that are perhaps a bit more efficient than others. And I'll hand back over to Andrew to explain those.
So the proposition about vertical integration is that we inherit an industry in which, particularly in Europe and the UK, we've been used to long leases. So that the typical model for an investment manager has been to collect rent from occupiers through the medium of property managers and often asset managers as well, or joint venture partners, so that the relationship between the investor, the ultimate investor, let's say a pension fund, and the occupier of the building that the pension fund owns is very, very distant. And therefore it makes it very difficult for the fund manager or the investor, the ultimate investor, to provide a great service to the customers, the ultimate customers of the buildings that they are owning, because they don't have that direct relationship. And that gets even more indirect when we look at the speculative development model, so that we can then produce a system where developers build buildings speculatively. They sell them to investors who had no say in the design of the building. They're then leased through intermediaries to occupiers who equally had no say in the design of the building and have no relationship with the developer at all. And that contrasts somewhat with a vertical integration model, which is characterized by people like Prologis in the logistics market, by Greystar in the residential market, maybe to a lesser extent by Hines in the office market, where the development production process can be undertaken in the knowledge of how the operation of the business works. So if you take an example of a rental residential operator who can design rooms knowing how they are operated and used by occupants to produce more efficient buildings in the development phase, and then can raise capital more efficiently because they are highly credible operators of the space that they're working within, so that we see this increasing importance and credibility of the vertically integrated operator. And this is going to be a real challenge for a lot of investment managers. It's not to say that the only successful investment managers will have to be vertically integrated specialists. That's not the case. But I think it is the case that those who are vertically integrated will be in a great position. There's also room, of course, for the allocators who will find the specialist niches and seek out the operators who are very good at doing this and make sure that the capital is raised and sourced for those developer operators.
And as the need to get to grips with the operational aspects of investment management increases, it's my belief that the S in the ESG will become paramount. We're already seeing assets in the market fetch a premium for environmental accreditations. These are your BREEAMs and your LEEDs. However, when you consider that the average occupier spending is 90% on their staff salary, it's our belief that those assets that can actually improve the productivity, satisfaction, and well-being of the staff will be those who will be fetching premiums in this new world. So the way we see this actually occurring is through two ways. The first is top-down, and these are new accreditations. There are a lot of organizations in the market trying to create a smart building accreditation. So Wired Score are one of the more famous ones you may have heard of. And undoubtedly, these smart building accreditations will include measures of occupant satisfaction. So they'll include technologies such as predictive temperature control, air quality, and lighting, which have all been proven to improve the productivity and well-being of the occupants. So the first is the idea that these buildings who have these smart technologies will achieve a smart accreditation, and these technologies also impact the productivity and well-being of the occupants. The second is more a bottoms-up user feedback driven through technology. We have a company in our portfolio called Office App, through you're able to book meeting rooms, and then the users of those meeting rooms are able to give feedback on how their satisfaction with that meeting room. And we also have a landlord agnostic daily office booking platform called Hubble. And through them, you're able to book meeting rooms and you're able to rate your experience with those meeting rooms. And so it's the idea that post-COVID, as there is an increase in working from home, as many predict, that we'll end up with this additional supply of office space. And the idea that this will open a huge opportunity for redistribution of demand through software. So we can imagine the Airbnb for office space. Now, for those that are skeptical about this, perhaps this proposition, WeWork recently announced across 160 locations in 11 US cities that they were doing exactly this. So they're dropping their membership model in favor of anyone, anytime bookings. So you can imagine that people will log in, and just as we do with TripAdvisor, just as we're willing to do with Expedia, we will be doing with offices. For me, it seems completely ridiculous that we would go for a 2-day weekend break and we would scour through all of the different information about the hotel that we want to stay in to pick the perfect room, the perfect price with the perfect facilities in the perfect location, when the offices we work in every day for years on end go without such scrutiny. And I believe that this will occur, it will occur soon, and this will inevitably bleed into asset value. However, before we can do anything with granular data and bottom-up information, there's a huge need for data integration and for software integration. We point to the silo, excuse me, we point to the silo management structures that exist within real estate investment management and all the siloed software systems that have grown up around that. So what the industry is confronted with is actually disjointed data that doesn't move between software systems. The top reason why commercial owners have stopped using a given tech solution is that it failed to integrate with other tools in their technology stack. While the activities requiring most time and effort to manage data is manipulating and transforming that data and actually managing the data between the applications internally. So again, this idea that there is just not a flow of information occurring seamlessly as it does in other industries. We held 2 roundtables back in October with over 40 participants from leading real estate investment management firms. And what we found from those roundtables was quite telling of this need for data integration. And that's that there's a lack of knowledge about how data can be used. There are low incentives for data sharing. There's a mismatch between the data that investment managers collect and that which their LPs request. And there is a high sunk capital cost going on supporting legacy software systems as opposed to switching to emerging systems that are perhaps more efficient. Most importantly from these roundtables was the belief that there is a lot more that software could do if there was a better integration of solutions and data. While again, we see both bottom-up and top-down attempts to create more efficient data integration, our belief is that a top-down industry data standard, such as that historically by Pisces and currently by Oscar, is largely doomed to fail. And that's because historically, these standards have been unable to keep up with the pace of change in the real estate investment management industry. Much more likely, we perceive as a technology-driven bottom-up solution. And that is one that's able to use machine learning to identify the commonalities in different systems to generate a single data standard. It's the idea that we could train a machine to trawl across various different reporting structures and identify those common points, regardless of language, regardless of culture and how the industry in that country reports, and pull it into one single reporting streamlined software structure. Most importantly, technology will drive transformation, as is evidenced throughout this report so far. In the financial markets, it's believed that fundamental change will occur by 2025, driven by technology. The reasons the Americans are so skeptical, the report that this fact comes from says that it's perhaps to do with the relative maturity of US companies compared to their counterparts. However, it's my belief that the timing of the report released in 2018 would kind of coincide with the crypto frenzy in the US, where a lot of investors got burnt in quite high profile cases. So perhaps they're a bit more skeptical of technology when this report was undertaken, but still it's conclusive across the board that the majority of the world believe technology will drive investment management transformation. Specifically with real estate investment management, most predict technology will improve screening, it will favour the larger firms, and it will create better matching. We agree with those sentiments, and we actually conducted our own review of the application of technology within the real estate investment management industry. And what you can see is we found what we perceive to be some of the major players and the more exciting startups under each of these the themes that we touch on in the report in quite depth. And what we perceive as perhaps one of the major report findings when it comes to the application of technology is that the distribution process will actually see technology application prior to the manufacturing. And the thought behind this is that distribution can borrow from the wider investment management technology stack. We only have to look at technologies such as Zoom and Microsoft Teams to understand the impacts that these generic software systems can have on the investment management industry. However, manufacturing process requires a lot more specific software and prop tech, which is perhaps not so mainstream at present. Our market mapping exercise also highlighted how underserved operations, compliance, finance, and fund structuring are by technology. While it was clear from our roundtables and numerous discussions with industry insiders that what they really want is an end-to-end transaction and asset management platform. Within our 5 years at Pi Labs looking at the PropTech startup ecosystem, we've yet to see a solution to this problem. What we do often come across, however, are platforms that aim to democratize access to institutional grade real estate, which hopefully Andrew is able to talk to now. You're on mute, Andrew.
Apologies. We put out a report about a year ago on real estate tokenization, and our conclusion was that there's been a lot of hype about blockchain, cryptocurrency, and the tokenization of single assets. But there is a need for a much more efficient way of distributing funds through the primary market and through the secondary market. So if you imagine a large investment manager creating a platform for initial capital raising for qualified investors, and then allowing those qualified investors to trade their units between each other through a digital platform, the funds are already tokenized, they're already fractionalized in units, they're already in the right legal format, they're already regulated. The whole thing works extremely well, subject to that technology investment. The jump comes between getting one manager's platform to work to getting different managers' platforms working together because of the KYC issue. Now that in itself can be overcome by RegTech, which we'll see. And the challenge is to grow the market in an efficient form. So according to Saull's, this is pretty heroic measurement, it has to be said. Nobody really knows how big the real estate market is, but let's say it's worth $230 trillion, which is the Saull's number. A large amount of that is non-investable. So non-investable meaning owner-occupied housing, land, public assets, owner-occupied commercial real estate, and so on. But it leaves about 35 trillion of investable assets, according to a group of investment managers who've tried equally heroically to measure that space. But let's say it's 35 trillion investable institutional assets. That is then split between 3 trillion in unlisted funds, about 5 trillion held in REITs, and about the remainder is then privately held. So it's in separate accounts or it's held directly by sovereign wealth funds, pension funds, and so on. Of the 3 trillion in funds, 2 is in value add and 1's in core funds. Now, the trick, of course, is how do you grow that 3 trillion in funds when there's a 228 trillion universe there? And that requires much more efficient capital raising, secondary markets, and much more sustainable businesses. And of course, one of the reasons why it's difficult to grow a highly profitable fund management business is because of this disaggregation across the market and the lack of scale that we can see. In combination with the idea of data, so I'm going to come back to the idea of data again. So the first thing to say is that the league table for the leading real estate investment managers is horrifically volatile. There's been no stability at all in the league table. So only 10 years ago, 12 years ago, ING was the biggest real estate investment manager in the world. ING isn't there anymore. Reef was second. They're no longer around in that brand anyway, and so on. So these managers tend to get rebranded, they merge, they get sold off, and the league table today has got maybe half of the names that existed in their original format 10 years ago or 12 years ago. So this tremendous instability in the league tables is one thing. The second thing is that a couple of managers, Brookfield and Blackstone, have been pulling away, so that they are creating much more significant market shares than they used to have. Having said that, they still have pretty small market shares of a $35 trillion market. So these managers have got about 200 billion under management now. As a proportion of 35 trillion, it's a pretty small market. But the ones that are going to grow are probably the ones who are going to access the data that we talked about. So if vertical integration leads to more data coming up from the customer, you'd expect the bigger managers, the most vertically integrated managers, to have more and more of that data. And what we know from Amazon, Google, and other industries is that those guys who have most access to data produce better products. Those better products sell in bigger quantities, and that leads to more data being collected. And so you get that virtuous circle. And we have to remember Amara's law, and that is to the effect that we constantly overestimate the impact of technology in the short run, hence the spoofing about cryptocurrency and blockchain, but we underestimate it in the long run. So the only question is, when is the long run going to arrive? And I think it's the view of Oxford and Pi Labs in this joint report that that's going to come faster than you think. So thank you very much for listening to the presentation.
Yeah, so thanks, Andrew. That was fascinating. I'd just like to say that the report will be downloadable as soon as this presentation is over, so at 5:30 after our panel. And you will receive an email in your inbox as well that should allow you a link to download that report. Thank you for listening, and we're now about to hand over to our panel. Oh, sorry, I can't see my mouse. And I'd like to introduce Andrew to welcome our panelists.
Thanks, Andy. That's very, very helpful. So we're absolutely on the button at 4:30, which is incredible. What's equally incredible is that we've got 4 great panelists, and I'd like to introduce them one at a time and then hand them over. Give them the chance to introduce themselves better than I can. But first of all, we have Stephanie Bensimon, who's head of real estate for Ardian. We have Christoph Schumacher, who's head of global real estate for Credit Suisse. Welcome. We have Lloyd Lee, who's managing partner at U Capital Investment Management, and Cate Agnew, who's chief valuation officer of Natixis, which owns, amongst other brands, AEW, a very well-known real estate fund manager. So if I can hand you over one at a time to introduce yourself. Stephanie, tell me a little bit more about what you do, what Ardian does, and then I'll ask you for your reactions to the report after you've managed to do that.
Okay, welcome everybody. I'm heading Ardian Real Estate, as you said, which is the real estate arm for one of the leading private equity firm. Ardian was the ex-AXA private equity, so we manage 100 billion of assets, mostly in funds and bio in infrastructure. And since the firm became independent in 2013, we launched the real estate business in 2016. So we've raised close to 2 billion through 2 successive funds, discretionary funds. We do direct investment for office and mixed value-add projects in some of the big cities in Europe. And one thing that is really important, and that also you mentioned in your report, is that we have this model of being very operating and very strong ESG approach. So basically our focus will be really to work on obsolescence of the assets and really adapt them to the future trends, how the cities are evolving, and how we can create value out of that.
Great, Stephanie, thank you. Christoph.
Yes, thank you, Andrew. I'm with Crédit Suisse Asset Management. We have about 75 billion in real estate under asset management, and we are quite an old traditional platform. We started our first fund in 1938, so it's more than 80 years old. And you can imagine over all these years, there's a high demand to amend our technical background and to work on how we manage these large portfolios. It's in Switzerland, it's in Europe, it's in Asia and the US. So it's a global portfolio which we have to manage for our investors. We have core plus value add activities. We do a lot of development. We do a lot of property and asset management. So all of this is very important to our investors, and to serve them with the most advanced technical surrounding is very important for us. So what we did actually, we created a new position of a Chief Technical Officer, who's now actually taking it on to the next level. We actually took a big budget to work on that. But as you can imagine, it's a lot. It's a question of capacity. It's a question of change management. And you mentioned it in your in your paper that these are the things who restrict our capacity and the speed of change.
Christoph, it sounds like you got an incredible data challenge there, given the scale of the operation, and we'll come back to that in a minute, no doubt. Cate, tell us about the work you do, please.
I'm Cate Agnew. I'm with Natixis, which is part of VPCE and headquartered in France. My world is the debt world. We do loans on all manner of commercial real estate, generally concentrating these days on industrial, which tends to be the sexy asset in spite of the fact that it's dull. I think that's what makes it exciting. We look at entire portfolios, and then we look at single assets as well. The business model of my group is to close loans and then to take them out to market in some form of distribution, CMBS, notes, different tranches. So for us, one of the data challenges that we have is making sure that all the secondary market investors in our products have the same information, and it's very easy to take a look at. But we're also a conduit on information from the market that flows through the valuation process and out the other side to make all our decisions. I think some of the challenges that we are facing right now is anytime something is digitally re-entered from one source to another, you're going to have data lapses and a lack of data integrity, which requires you to go back over things again and again to make sure that they are appropriately presented and properly analyzed. With that in mind, technology would resolve a great bit of that, because we could automate procedures and wash out the data noise. Being part of the appraisal world, the valuation world, we want to make sure that the most data that we have is the most transparent data that we have, but then we fight data privacy issues at the same time. And I think that's universal in real estate right now.
Right, it's very, very neat is that sort of tension between privacy and the need to be more data efficient. Lloyd, please tell us about your business.
Sure. So I'm Lloyd Lee from U Capital. Thank you very much for having us here today. U Capital is a private partnership. We focus in the UK, and our specialty really is that we are a private partnership that does special opportunities. But particularly, I think what's relevant for today is that the way that we've successfully delivered returns for our investors in special opportunities is, number one, we are incredibly focused on community building. And if you look at what we're doing at Olympia, which is 2.5 million square feet for the creative industries, we're not only focusing on building live entertainment venues. We just had a press release come out yesterday that we're opening the first major live entertainment venue in London, announced in many, many years with Anschutz Entertainment Group. We're also opening a new Hyatt Regency and also a new Citizen M hotel. But we also are opening trying to open a new private partnership for a school for the performing arts. And we're doing a lot of community outreach as part of building this community of creatives. And if you look back over the history of the firm, building communities has been a big part of how we actually generate returns. And the second part is that in our business, as you were saying earlier, we are very much in operations in our real estate. So we're talking about owning hotels, restaurants, exhibition centers, live entertainment venues. We're going to be opening 5 live entertainment venues at Olympia alone. And as a result, we recognize the fact that if you're going to be in the real estate business and you're trying to generate real returns for your investors, we agree. it is imperative that you have the in-house capability to underwrite, to manage, to identify and work with world-class partners in operating your real estate assets yourself.
Yeah, which again is a data challenge. You know, as soon as we use partners, then we have that data sharing issue. I'm going to ask you all the same question now and wait for the first one to volunteer to answer it. But I'm going to ask everybody to answer this question. So what is the one thing that you really agreed with in the report? And what is the one thing that you agreed or disagreed with most? So one thing that you really agreed with and one thing that you disagree with. That would be great to hear. And anybody can go first.
I mean, I'm happy to go first. I think that at the end of the day, what resonated with us obviously is the operational component and the ESG, because frankly, that's who we are. It's what we live and breathe. What I would say more specifically is that, you know, and I was late because I was just on a call with an investor. One of the things we just told them 20 minutes ago was, we are utterly convinced we can prove to you that if you look at the history of the last 10 years and almost £1 billion sterling of investments by the partnership, we can demonstrate to you why actually approaching community building actually generated higher returns than if we had did it the other way, which is let's just build a whole bunch of luxury housing or whatever it is, and do it with that model. By building communities, by building affordable housing, by putting in schools, by creating community spaces, what we found is that the private sector said, that's my neighborhood, that's my culture, that's what I want to represent to my clients who I am. And what happened was they started conglomerating around our spaces. And that for us was the beginning 10 years ago of an understanding of where we think the world is going, and particularly where people like us need to be ahead of that curve to build those spaces in that way where people can say, that's what I want. You finally showed me what I want.
And yet, you know, we learned, didn't we, at one point that funds should be diversified?
Well, I think diversification as an asset class and the fact that we're building communities, if anything, are more complementary to each other. Because what you're saying is, I've taken 15 acres and instead of doing 4,000 luxury homes, I built hotels and restaurants and offices and live entertainment venues, which means I have 7-day-a-week trading. I have different footfall patterns throughout the day. I've got diversities of income profiles. And as a result, it actually gives you a better quality risk-adjusted return and income profile when you look at those kinds of situations. So from our standpoint, we quite like it.
Great, Lloyd. I'll come back to you in a minute about what you disagree with most. So Stephanie, you were going to tell me what you agreed with, I think, and maybe what you disagreed with as well.
Yes, to what I think it comes to also what Lloyd was saying, which regards to the fact that you and also what you're saying about being an operator. I think that's really the key today. If you want to bring value, we are investor are taking into consideration that returns will be lower, that they can afford having double layer fees as well with operating partners. And on top of that, technology has completely changed the way we live. You are talking about communities, but that's also how we occupy offices, how we shop, and all that means at the end that if you want to bring value, you have to use technology because you have to make sure that you know exactly what your tenant wants and how you measure that. But also, you know exactly your market, you're very local. And I think that's really key. For example, in the way we have started the business quite late in the cycle, and we made huge deals and sales, even recently, online leasing, online sales. And because we have all the tools like videos on the asset, visiting, you could visit the asset by remotely. You could also have everything, the 3D plans and everything that we could offer to tenants. And we could also have the flexibility to change some of the capex and the asset, and making sure that because we have all the expertise within the team, we know exactly how to speak with the construction company, and everything is in-house. And I think this makes a huge difference when you talk to tenants and you talk to people that will live in your assets. or will go to shop to your assets, it makes a huge difference on how you bring the value. And I think this is really the key for the future, and you mentioned it very well in the report. One thing that I was not sure I was agreeing was capital raising and how you can raise capital with digital tools, because we are experiencing that. You know, at Ardian, we are launching a big project integrating all the, you can onboard online, you can have your asset management reporting and everything directly in the system, which is great, and especially investor that has different expertise with you as a manager, it's like they like it very much. But I found if you want to source new prospect, you want to have, we're having Zoom every day, but the way you can convince people, I mean, there is something that I'm not sure will manage only through digital tools. I see, challenge at the moment, having the same rhythm. Of course, there are a lot of uncertainties on the market, but I see, how human relations can also be very key in the way you want to do those things. So that was my...
Okay, great point taken. The customer engagement software that you talk about, or your customer relationships, have you had to build in-house systems to do that, or are you being able to buy things off the shelf?
No, we worked with BCG and completely built from scratch something that were fitting the process, also fitting the regulation, compliance, and everything. So it was like it's a kind of very long project that the company has started 2 years ago, and now is piloting with some key expertise right now. Okay,
great. Cate, agree, disagree?
I agree with the overall tone and flavor and the individual parts of the report that are pointing to the fact that we have a tremendous amount of data locked up in a lot of different systems that aren't talking to each other. There's a lot of siloing what's going on. And I think that part of that is there is a somewhat zealous protection of each function. A property manager has a particular software that they're using, and they feel as though they don't want to expand outside of that because the human factor, again, people know that software, it's an investment of time, it's investment of money, and it's just a little bit on the scary side. So they want to stay with what they know instead of expanding outward with something that might be better. So the siloing aspect of it carries forward in every other aspect of property management, of property investment, of how returns are reported, how a group like Reonomy breaks down the different components of value. Trying to find the common language between all of them is something that a number of organizations are attempting to tackle. It's a big issue to tackle. Everything from the International Standards and Ethics Coalition to Rick's organization, everyone's trying to tackle this, but there's still a lot of crosstalk. We're staying in our silos instead of breaking them down. That's why this is a really exciting initiative. But I think what I disagree with, and I'm dovetailing what Stephanie said, the negotiation part of this, we're talking about the fact that in the report, there's a certain illiquidity being introduced into the process because it's so human oriented and because it's so, I don't want to say onerous, but there's a lot of back and forth going on. I think that's actually something of an advantage in the negotiation. When you're working to do any kind of transaction, you need to be able to not just KYC from a regulatory standpoint, but know who your business partner is. Because any transaction is going into partnership with someone. Even if it's a sale and you're releasing it, part of who you are and how you develop that goes with it. So I agree that there might be some form of illiquidity in a negotiation introduced by its slower pace. I think that is also an opportunity to take a breath for the human participants to understand the mosaic of the deal and where they're going with it.
Great, Cate, thank you. I mean, do you think there's a size issue here? Do you need to be a company of a minimum size in order to be able to invest in the data systems that you clearly think you need to invest in to reduce these inefficiencies?
I don't see that at all. There's one program that I use and my industry uses for a discounted cash flow analysis, and It's been around for a number of decades and it's very expensive. I've recently acquired a second one that's far less expensive that I'm using to double team and do a back check of the assumptions going in the first one. It's quite a bit less. And so the scalability of that for the providers to me of valuation services will be quite easy to access. I don't think it requires a big budget.
That's great news, Cate. That really is. Christoph, you've waited a while, but I can imagine you've got a negative and a positive. I hope you got a positive.
Yeah, definitely. Let me, however, start with the negative. So I do agree with Stephanie and Cate that, especially on the fundraising side, you need the personal contact, and that the report is on that side a bit too much technical driven. So positive, I definitely agree with the challenges for our industry with regards to increased regulations, with regards to the valuations and the lower core return. So that is definitely something we're gonna face, and we have to be honest. I mean, real estate takes time to have the impact. It's not that the impacts are not as immediate as in other industries, so it takes time. However, it's going to come. It's going to come more severe, these impacts. And so I totally agree that we have to face it and we have to react and respond now. With regards to change management, and I mentioned that earlier when Andy talked about the challenges with regards to the technical implementation in our industry. I think it's a lot, and Cate mentioned that as well. It has to do a lot with change management and capacities. People are willing to change, but in the end, they stick to their silos, and our industry is so small compared. I'm part of a large financial institution, and if you look into other business lines, the amounts are much larger. We are tiny. Yes, Cate said we don't need big amounts and budgets, but then look, we have got architects, we have got developers, we have got constructing companies, we do have fund managers, we have like all kind of tiny and small participants in our industry. It's so diversified, it's so small. And coming back to the IT industry, we're not that interesting. So that's why we're so late. I think the prop tech, for a reason, came very late into the scope of these large tech companies, because it's so complicated.
It's a great point, Christoph. I found myself at a conference in Norway earlier this year when I said, well, you know, one of the problems is that if you're a really good chief digital officer, why would you work for a real estate company? And I realized that the room was full of chief digital officers working for real estate companies, which gave me a bit of a problem. But it is an issue. You're not going to be in that industry, are you? Okay, great. And I know that you're all required to do a great job promoting your businesses, and you're all required to be optimistic. Otherwise, it's difficult to get out of bed on a Monday. But what are the challenges that you face? You know, what is it that makes running a real estate investment business difficult? You know, I threw in capital raising. I mean, I completely accept your reliance on human beings. I do understand your point. But I do wonder whether it's sustainable to get on the aeroplane as many times as I've used this example many times. But one of my favourite fund managers in the UK recorded 497 meetings to raise his $900 million fund, and I do wonder whether that really is sustainable. And I've seen a lot of businesses sell themselves to bigger companies recently, or to investment platforms recently. You know, we've seen a lot of PE managers go. I do wonder whether it's really sustainable doing this every 18 months.
Look, I'm happy to kind of jump in and share my 2 cents worth. At the end of the day, I think there's a reason why, for all of the great things that technology are already doing for the benefit of the industry, for the real estate industry, one of the things that is fundamentally intrinsic to the DNA of our industry is it is by definition location driven. So how many people have actually bought a house without ever seeing it, without knowing where the city is located, without knowing where the school systems are for the kids? Like nobody does that. You walk through, you got to see the kitchen, right? It's because that's the built environment. And as a result, it's very, very difficult to actually dangerous to try and commoditize it, which is like, yeah, all houses are the same, all hotels are the same, all buildings are the same. And we all know that being across the street on a dual carriageway where there's like, 50 meters of iron fence between both lanes is a big difference depending on which way the traffic goes and which way that you're on the street. And as a result, at some point, I do think that, as we've all been saying, that human element and that very localized understanding of the real estate industry is fundamental to getting it right, and probably can never be commoditized, because it is literally the anti-commodity. There's one of a kind in many cases. Yes, certain parts of the industry can be commoditized, but I think to assume that technology can do the whole lot, I think is antithetical to what it really is that we're talking about.
So does that place a natural limit on the size of any very good real estate investment manager, to the point where that they can't really grow and create the economies of scale that will create the Amazon, the Google of the real estate business? Is that the fact?
I think the answer there is possibly not. And the reason that I say that is because if you look at the Blackstones of the world, they're not trying to run a portfolio with 3 people in a huge Bloomberg terminal. What they're doing is they're saying, we have a way of investing. We have a way of approaching the market. That's why we're number 1 in assets under management, returns, whatever it is. And as a result, we've inculcated into our people the Blackstone way. We are militant in the way. We're literally like a military organization, and the way that we've gone out and conquered different markets. And if you look at the quality of infrastructure in Asia, in the Americas, in Europe, of the Blackstone Group, for example, there is a reason why they are that successful, and they've been able to grow AUM. And I suspect that when you look at them 10 years from now, they will not be 10 or 20% bigger. They will be double, triple, quintuple, 10 times bigger than they are today. And that piece, that is about management. That is not about the local thing, because they're growing people as much as they are assets under management. So I do think it's possible.
Thank you. They will say, Lloyd, and this is a question for you, Cate, now, that they will say that they employ 25 data scientists. And I, that's quite a convincing thing to hear in a pitch. I wonder whether we actually all need 25 data scientists, Cate, to understand the way the property market really works. Is that right?
I think it's interesting to look at the numbers in that viewpoint. If you have 25 data scientists working for you, are they each looking to provide a solution and then look for the problem that goes with that solution? Or are they talking to each other across a platform? One of the drawbacks of someone being excited about the software program that they've created, that they've now reconfirmed to be part of PropTech, is they haven't begun by looking at what the problem is to solve. Instead, they've come up with a lovely solution, and now they're trying to find a problem to fit it into. I think a lot of the software programs out there are terrific, but they are being developed in a bit of a silo in and of themselves, when we're looking to them to break down those silos. So 25 data scientists, assuming they all understand 25 different areas that they're working together on, would be brilliant. But 25 data scientists all coming up with a solution and then figuring out the central problem to put them into won't be beneficial.
But we're quite a long way down the road of using automated valuation models to value owner-occupied residential property, I think. Would you agree?
Yes, I would agree with that. In the United States right now, we're 10 years into the Dodd-Frank regulations, and they specifically stated that there should be some structure around that, some governance of what is appropriate and what isn't appropriate. That hasn't happened yet. So the automated valuation models are all very interesting, very brilliant, very well populated, but there is no governance or structure around them. So if you look at something like a Zillow or Redfin or any of their competitors, they're all coming up with different values because their algorithms and their matrices are different behind there. Understanding and being able to peel back what the inputs are and being able to get insight into that, get that black box transparent, is something that the AVMs have yet to get to.
Yeah, although one thing we don't make a big point in the report. I mean, it's interesting to see the rise of single family rental homes in a fund platform that are valued, I suspect, through an AVM, which is sort of the first sort of near tech investment decision making I've seen. Christoph, Stephanie, what are the biggest problems facing you running your businesses? Yeah, nobody's keen to take this one first.
Stephanie?
Well
Okay,
done,
I go if you want. Go first.
ladies first, Stephanie.
Okay, great. I think one of the things we mentioned also at the beginning is the challenge is how you create value in a world that is completely changing with technology. And I think for me, that's really the key things that we have to face is that real estate is always behind because by nature, we are, when we invest and when we build new assets and we try to convert them and you know, also building homes and everything, it has to come first from the change in the way we live and etc. And I found it very difficult so far because change, the revolution that we are living right now is going very fast, and real estate is a very long cycle. And you were mentioning we have long lease, we are not flexible, and I think that's one of the things to integrate and also helping you know, the fact that we use that data to help us is probably key also to make things more flexible, because then it means that long lease will not be you know, the value necessarily, because at the end of the day, if you cannot adapt the quality of your assets, then you have 10, 15 years lag in the way you can offer the good product to your tenants or to your investor at the end. And I think that's one of the key challenge you know, we're trying to solve, and by having, of course, this local approach and adapting and using also technology to help us improving the process in general, because I do think that technology will also help us to process things more quicker, and speed will definitely also help also the volume, because what we feel also is that there is more and more liquidity for real assets and real estate, and you mentioned trillions, but that's also what we see is we feel investor wants to deploy liquidity into this asset class, but at the same time they want more niche or diversification and some good proposition compared to how you know, the general trends of also the cities and the society is evolving. And I think there is a lot of attempt, for example, the co-working, the you know, how you mix your assets with co-living or not, whether that works or not in every market, etc. And I think all this initiative at the end of the day shows that real estate is so hard, because historically we went very, very lagging of any evolution, and it takes time. And I think we don't have the time, because this, you know, we are changing so fast with digital tools, with everything, that we have to adapt, and we have no choice. And that's for me the biggest thing. And it has also to come with having more volume, having more transparency in the way we work, the way we report to investor, and that's the kind of things that we, you know, as an investment manager, we have to face in order to bring value to the investor that choose us as a manager.
Great, thank you, Stephanie. Last word from you, Christoph, I think.
Yeah, Andrew, just in addition to what Stephanie mentioned with the active management, one challenge for us is really being SEG compliant in a time where we really want to be SEG compliant. Like, especially our bank, our owner, really wants us to work on that. And we have been working on that for the last 20 years, almost, or 15 to 20 years. So we have a green book to our developers. We work with Siemens on a program to make our assets more compliant and less CO2 emissions coming from our assets. But nevertheless, having a portfolio of 80 years and older to change this existing portfolio of 75 billion and the core portfolio that delivers maybe in Switzerland 2% to 4% returns, and then work on all the changes, especially given to us by the governments, by the EU. And I mean, we want to change, we want to be ESG compliant, and we're gonna do that, and we will be, but nevertheless, it's challenging to really have all these changes on the existing portfolio. It's easy to have new developments being ESG compliant and work on that, but the existing portfolio, that is a big challenge, in addition to what Stephanie and Cate mentioned already, and Lloyd.
Thank you, Christoph. Thanks to the four of you. Please hang around. We've got another 25 to 30 minutes yet, and we'll be coming back to you from. So we'll be getting questions from the audience and we'll be putting them back to you. But before we do that, I'd like to go back to Andy, Saull, and then to Faisal for their reactions to the panel. So Andy, what did you pick up from the panel?
I've actually been monitoring the questions in the chat quite closely. So I'm going to kind of try and feed in what we've been getting from the audience. One of the first things I quite liked was a rebuttal to Christoph saying that we will not be using these platforms for matching between the assets and the for capital raising. And someone simply turned around and said 20 years ago we could never have envisaged a dating app, yet that industry is now huge. There are millennials using it the whole time. This ties into another part of the conversation I heard, that was that someone was questioning whether we actually just need the next generation of investment manager to come through who are a bit more tech savvy to really drive that change. So they're two quite pieces, quite nice food for thought. One of the questions I really enjoyed that I could perhaps pose, but I'll hold that. In fact, we'll go to Faisal, because the question that people are asking around prop tech, and excuse me while I bring it up, is purely where do you see the biggest opportunities in prop tech? And another question was, what makes real estate solutions so distinctly separate from other real assets? So I think those two questions would be a really good place to start before we then ask the questions to the rest of the panel.
Great. So Faisal, we were interested in thinking about the startups that you see and where you see the really good activities, where you think there are really holes in the market, and what are you seeing at the moment?
I mean, there's so much that's been said earlier that partly that I agree with and partly that I disagree with, and I'd like to just perhaps shed some light from the innovation side of things, some of the cutting edge ideas that we're seeing and actively investing into. But what I want to address first is on the capital raising side, which is a topic that's been brought up by many of us. A lot of the views that we're hearing today, I would suggest, are a pre-pandemic view. Now, what people haven't recognized is that just in the last 6 months during this pandemic, innovation has taken place in how capital is being raised globally across any type of asset class. So whether you're raising capital for real assets, real estate, infrastructure, or for private equity and venture, we're all now pitching on Zoom or Microsoft Teams equivalent, and we're sharing our screen, we're sharing our pitch decks on screen. The travel element that Andrew referred to earlier is not in place, and many of us are closing funds during the pandemic. LPs on their end have had to innovate themselves on their processes, and many of them, some of the early adopters, have decided that they will be able to underwrite a new investment cradle to grave completely virtually. So the pandemic has already triggered and been a catalyst for change in the capital raising world. And I think that that's going to lead on to a lot more digital innovation to come. So just wanted to point out that I feel like some of those views are a pre-pandemic view. Things are already changing. On the point made earlier, I think it was Lloyd and some others around data and the use of data analytics. We've already seen very sophisticated data analytics platforms come to the market that have helped institutional real estate investors really fast track their underwriting, due diligence, and the ability to take a deal to investment committee a lot faster than those that are using more analog processes, using Excel and doing all the data gathering manually. So I think data analytics speeds up the pace at which you can take a deal forward. And on the slightly more cutting edge side, we're taking a investment to IC this week, which is basically, the simplest way to put it is it's artificial intelligence that would replace some of the analysts on your team. So if you wanted to, for example, ask questions such as, if I reposition this office building into student accommodation, what would my returns be? Your analyst would have to work a number of hours gathering information from your internet, et cetera, crunching numbers in order to arrive at those answers. Whereas AI can go through reams of data very quickly, do the scenario analysis for you and give you your options in split seconds. So I believe that your future, the real estate investment managers that are going to win in this space will have human analysts supplemented by AI analysts. And then that probably sounds very futuristic and something you'd see in a movie, but we're already seeing this innovation come to the fore and we're investing in it.
Great, Faisal. Yeah, absolutely. Yeah, I mean, I got a reminder on my PC today that there were a few things that I'd said I was going to do that I hadn't done. And that wasn't because I'd recorded them in my tasks box. It was because the system had gone through my emails and picked out things that I'd said I was going to do. And it told me that I'd said I was going to do these things. I hadn't done them yet. Yeah. So that's AI, and it's insidious, and it's creeping all over the place. We've got some great questions coming in, by the way, and I'll sort of deal with the first one myself and then throw the others at the panel and to you, Faisal, and you, Andy. But one here, do universities offering real estate degrees need to up their game and offer more than chartered surveyor training? Well, absolutely, but I think you'd be shocked by the technological capacity of the young people going through these universities. They know a hell of a lot more about tech than the teachers do, and there are plenty of university courses that understand the importance of innovation. So I think that's the last place you should be hitting people over the head. I mean, another question is, do we need to see a younger generation running large real estate businesses before we see drastic change? Is the problem that 67-year-olds like me struggle to download Zoom and get it working, and that actually the younger people are the people who are going to make the real change? So that's a couple of sort of contradictory points coming in. One other serious point coming in that I'd love to throw to everybody is whether the agents in the market, and that's sort of defined very broadly. I don't mean estate agents specifically, but the intermediaries in the market, are they a catalyst for change, or are they an inhibitors, the way that they operate? That's a question for anybody, I think. Cate, your mic's on.
It is on, so maybe I should turn it off so I don't get picked on all the time. That's an interesting point. If you're an intermediary in this market and you are someone who is wedded to a particular software program or a way of analyzing, you then become the gatekeeper of what goes where and how. So by going to the intermediaries and have them propose and adapt new software and new solutions in PropTech, that could have a radiating effect outward to the participants. They become sort of the key in the center of it. Conversely, they can become the block. So that's an interesting thought.
Yeah, I mean,
now I'm going to go on mute.
Okay, thanks, Cate. Yeah,
series like the likes of JLL have allocated capital to PropTech before a lot of owners have. So in many ways, they've been kind of ahead of owners in terms of recognizing the change that's coming and putting their capital where their mouth is and actually making the investments.
Yeah, I'm certainly not trying to beat CBRE, James Lang, Cushman and Wakefield round the head. What I'm really talking about the sort of existence of intermediaries at every stage through the process, because we have developers separated from capital sources, separated from landlords, tenants, asset managers, there's inevitably going to be the intermediary, and the intermediary could be a lawyer, for example, who says, well, the tenant won't sign a lease like that without asking the tenant what the tenant really wants to do. I think we do have this problem of intermediary challenge across the place. Any responses to that before we pick up anything else?
Well, on the legal side, we've just invested in a company called Baum, which actually sets up your fund structures and your SPVs, and you can basically, the end user, which is the principal investor, can specify exactly what kind of carry waterfall you're looking for, the fees, etc., that the sponsor would have, and it auto creates the legal documents for the fund manager. And I think that there is change coming down to the structuring of the fund structures and the legal documentation. Right now, the conventional way is to go to a big law firm and they do all the legal structuring for you. We've just invested in a company that's growing very rapidly on the smaller end of the scale for small managers, but that's usually how innovation comes to other industries. It's the smaller early adopters who help the tech firm iron out the kinks, and then the product becomes very sophisticated and becomes a real challenger to the mainstream incumbent intermediaries.
Yeah. A quick question for Lloyd, Christoph in particular, I think, and Stephanie, giving you all notice, but the evolution of secondary trading platforms for investors in your funds, what do you think your view is on that? Are you working on helping investors trade units between themselves? Is it something you would resist? Where do you think the industry is going on those issues?
Well, I can easily go first because of the three, we are far and away the smallest and the most specialized. We're high returns, opportunistic, the tickets are large. So it's really not a retail industry. I mean, the minimum ticket size is 5 to 10 million pounds per investment. So, and the investment is of a nature where you have to be a sophisticated investor in order to qualify to come in. So there is an institutional secondary market. That's what the secondary market is, where those LP positions will trade. However, bringing it, and I saw a comment in the chat box, bringing that to the retail investor has massive regulatory challenges ahead of it, which is, should a retail investor be asked to invest into things of such a high volatility nature, where there's a degree of expectation about what they know about the level of investment and risk that they are taking. So in our particular business at the moment, the regulatory bodies have absolutely put the kibosh on that one, which is, if you're not deemed an institutional or deemed sophisticated investor of a minimum size, you actually cannot invest. And we've decided against the idea of creating some kind of a feeder vehicle through a bank, et cetera, who conglomerates 10,000 people, because we said, look, that's kind of skirting around the edge of the whole principle of protecting the retail investor in the first place. So we're not going to do that. However, I think Stephanie and Christoph speak for vastly larger sums of capital, which probably could potentially offer something to the retail investor.
Just one point to come back with you on Lloyd. You said that, minimum ticket size is 5 to 10 million. Is that, there are plenty of qualified institutional investors, high net worths, who might be interested in investing $1 million. So are you not taking the smaller capital sizes because it's too expensive to take them on?
It's not so much that it's too expensive. I mean, I think we can, and selectively we would do it for strategic type investors. However, if you're raising, at the moment, even as a private partnership, we're not nearly as big as the others on this call, but we still have, 2 billion of AUM, all of it in special opportunities. And I think if you're raising that 1 million at a time, where because of the level of due diligence people are obligated to go through, they need to see all of your investor documents. They want to, it becomes even for them prohibitive, because at that point they're like, this is either not big enough to do it, and I've got to get together with 100 friends to do it, or frankly, I wouldn't pay someone all this time to go put $1 million to work. And so as a result, in our particular business, you tend to find that it's just more efficient for everyone, including the investors, to be at that minimum size.
Okay, thank you, Lloyd. Stephanie?
Actually, I share the view of Lloyd, because it is true that for small investor, small family office, sometimes we do have a lot of family office, and regulation is tough. You need to organize feeder, and therefore you start with a minimum ticket, and that's what we and that's sometimes a shame, because we see strong interest sometimes for small family office. On secondaries, I have to say that in our business, we recently raised a 14 billion fund for secondaries in LBOs. And I could not understand really why real estate should not follow the same type of patterns in terms of especially big institutional willing to change their portfolio, their position, and I think it will come. I haven't seen a big market, especially in Europe. Maybe in the US, there is a secondary market for real estate, but there is no reason. There is no reason why we should not, especially as the volumes are growing very fast right now. That you will have institutional willing to sell position from one fund to another, and that's something we've been trying to push. Sometimes we find investor willing to take some position on other funds, and because it's just a question of orientation of their strategy, but it's still very hard in real estate, and I have to say I don't understand really why. Probably because I would assume that some of the LPs are not sophisticated enough, or not, or just willing to keep their position forever in funds. But I think this will change, definitely.
Thank you. Christoph.
Maybe picking up on the last point of Stephanie, I think in many of our, at least institutional investors' portfolios, real estate is really a base they keep up to 10%, 15%, in Switzerland even 25%, but it's taken as a granted, and they just keep it, and then they've got the liquid assets where they work on, they trade. So they just have real estate as a non-liquid asset as a certain base to their portfolio. That's one point. Then coming to the secondary markets, it depends a bit where the fund is domiciled. In Switzerland, we have a certain liquidity in real estate because there is kind of a liquid market to it. It's listed to a certain extent. Sometimes institutional funds are listed, sometimes retail funds are listed. So there we do have the opportunity, and we don't really need a secondary market because it's going through that market. With regards to our Luxembourg-based funds, we obviously encourage some other, let's say, private banking clients out of our bank, if someone wants to dispose a position in real estate, to give it to someone else. So we try to help in the framework of regulations what is possible. So Lloyd mentioned that. It's just you have to keep the framework. With regards to the German market, you have, with the open-ended funds, a very restricted system to protect the other investors. Therefore, it normally depends on a lockdown period and so on. So I do agree with Stephanie. We don't see in continental Europe so many secondary markets. And it might come, and it should come. I mean, we try to get real estate more liquid. Well, let's see how that's going to come. But
okay, on a related point, are any of you excited by the prospects for the digital fractionalization of single assets? So we've heard quite a lot. It tends to start with blockchain and sometimes associated with cryptocurrency, but even putting those to one side, the idea that you could sell individual units in single buildings. There was a deal in Zurich announced last year, Christoph, that no doubt you were familiar with. Is this a market that's going to take off?
Yeah, go ahead, Lloyd.
I was going to say, in the UK, I know that there were times in the last 20, 30 years when you basically did that. It was basically a more advanced form of a syndicated limited partnership.
And of course, we have IPSX. We must mention that.
Exactly. And what happened was, and what concerns me a little bit about the history is that unfortunately it was tainted with corruption, which is you had unsophisticated investors. Real estate is a very, very local business. Things heated up like they do in like all kinds of public equities. But the difference is it was a lot less regulated. And so the entire industry got shut down. And as a result, I think there was some real taint that the real estate industry absorbed as a result of that. Do I think the idea of a retail buyer ultimately being able to own a piece of real estate that's very, very special, Covent Garden, I don't know, pick something, Shaftesbury, the idea really exists in the public markets today. That's what you own. And in the UK, it's very unusual, but you've got public companies that have like one asset in it. It's bizarre from a global perspective. But then when you break it back, That's what people own. I own one share in Covent Garden because that's pretty much 90% of the holdings of Capco today. And so I think in many respects, advancing that forward, where you could own a piece of real estate in a much more regulated share of something, I think is possible. And I think, digitization, the availability of information will probably enhance the ability to use that as a distribution platform in the future, but it does have to be highly regulated.
Anybody else have a view on that?
I mean, we've seen success in this space on the equities in companies, right? So you've had the likes of Cedars emerge, who are regulated by the FCA, as is Crowdcube, and recently they've announced a merger, so they're like becoming the platform for buying fractions in private companies. I think we just haven't seen the right platform emerge in real estate that's regulated in the right way, that's solved the distribution problem. There's lots of crowdfunding companies out there that are offering.
And of course, Patrizia bought Brickvest, Faisal. I'm sorry to cut across you.
Brickvest didn't work out, did it? Right? But distribution is the challenge. How do you get enough investors on a platform to make the economics work?
Yeah. Faisal, I think it's probably time to go back to you to wrap up. We're sort of 5 minutes short of our hard stop. So I think it's probably time to, I'd like to thank the panel, Stephanie, Christoph, Cate, Lloyd. It's been a great panel. It's been a privilege talking to you. Thank you very much for your input. And Andy, thank you. Back to you, Faisal. Thank you for hosting this.
No, it's been a pleasure. I'm really pleased with the discussion we've had today and the debate. I'm sure this debate can continue offline. There's a number of different points of views. It's great to hear. There's the very traditional view I'm hearing from you guys. We're on the front lines of investing in some of the next generation technology. So I feel like in a way we have this telescopic lens and to look into what's coming down the pipeline and what's already here. So what I would encourage everyone to do, we still have an audience tuning in, is our research paper will be sent to each of you. So I'd encourage you to have a read. It is there's an executive summary, and then there's the full piece, which I believe is 40 pages long. And Andy and Andrew Baum together have worked tirelessly over the last couple of months to put this paper together. I'm excited to now share this research with the wider industry, and we'll be making a number of investments in this space. So stay tuned for that. If you don't want to wait for the email, you can go on to either the Oxford Site Business School website or the PyLabs website to download the research today. So thank you so much, everyone. Andy, any parting words you want to leave the audience with?
I'd just like to thank everyone for the chat function and the Q&A, and we couldn't get through it all, but trust me, I've been reading it tirelessly, and a lot of what we're discussing is in the report. So there's a lot of people bringing up transactions, property passports. There's a lot of people bringing up the negotiation process. There's huge discussions about, can we measure social factors? And so please, it was fascinating to read. Please download the report. And as Faisal said, it's available on the website. So I just felt that I should thank everyone for their contributions. It was fascinating.
Thank you to the panel. Thank you to the audience. Thank you for tuning in. And we hope you enjoy the research.
Thanks, Faisal.